Small banks run out of cash. Bond defaults are causing the Chinese financial system to shake. Small and medium banks in China have to depend on cash from other banks because they cannot directly access the liquidity that the BOC provides. Some small banks in China are increasingly having difficulty borrowing on the interbank market. Another sign that a rising wave of corporate bond defaults is affecting the financial system. On November 30, the cost of a one-year interbank loan, which is considered a lifeline for small and medium banks, was 3.34%, twice as high. In April, this rate was also 39 basis points higher than the interest rate applied by the Central Bank of China. BOC for medium-term loans, the largest difference since July 2018. Small and medium banks in China have to depend on cash from other banks because they cannot directly access the liquidity that the BOC provides. However, a series of recent defaults by big-name companies have made larger banks more cautious. Another concern is the prediction that the BOC could soon revert to emergency stimulus measures that were deployed in the past to support the economy. Against the pandemic, recent economic data is inclined to this possibility, with the manufacturing index rising stronger than expected in November. Last month, BOC Deputy Governor Lu Guochang also said that the revocation of monetary policy is only for a short period of time and is necessary. That means even though the BOC pumped $30 billion into the market through its medium-term lending tool on Monday, which also pumped liquidity into the market every day last week, this was not enough to prevent the Chinese financial system from shaking. Larry Hu, an economist at Macquarie Bank in Hong Kong, said that borrowing costs in China will continue to rise, causing government bond yields and interbank rates to remain high. In the short term next year, there may be more defaults in the context of China's tightening policy and slowing growth.